You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koos, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
Hey everybody, NERDvember is almost over. I know you're sad, I know you're crying, but this is the last episode of the month. So we got lucky this year, those of you who like this more technical savvy stuff, because there was 3 Thursdays in November, and that means 3 podcasts. That means 3 NERDvember episodes, but this is the last one. We started the month in episode 1 talking about whether or not it makes sense to be buying or selling stocks right now through the eyes of time frame and how ridiculously crucial it is when building an investment strategy. Last time on November 16th, we talked about how to decide what investments to buy and a few different ways to pick investments and build a model portfolio. Today, we're just showing off. Now, that's not, well, I guess it's kind of true. But truly, this was said in an appointment we had with a client a few weeks ago. We were joking about how at the end of the presentation, we were getting really deep into the weeds with investing in model portfolios and how everything's done at our office. And when I pulled up a relative rotation graph, I said, okay, now I'm just showing off. But because, it's a pretty cool tool, as you're going to see here today. And it's one of the absolute easiest ways to visualize relative strength, which means identifying the good, improving, trending investments that are out there, all while avoiding the weakening, lagging ones, which is what we want to do, right? But before I get into it today, as always, a few housekeeping items. If this is your first time listening or watching, then thank you for joining us. I'm Adam Koos, President, Portfolio Manager, and Senior Financial Advisor at Libertas Wealth Management Group, coming at you from the friendly Midwest right here in Columbus, Ohio. Be sure to subscribe on YouTube, iTunes, and Spotify so that you're the first to get these episodes. As an added bonus, if you're interested in getting our custom-made articles, screencasts, and other free educational information, head over to libertaswealth.com and either click on the button at the very bottom of the homepage to get our free report on the top 5 questions to ask when searching for a financial advisor, and that'll put you on our list, or you can simply shoot us a message on our contact page and you'll be added to our inner circle and kept in the loop on all new educational material that comes out right when it's published. You can follow us on Facebook at facebook.com/LibertasWealth. We're on Twitter or X at twitter.com/LibertasWM. And you can also follow me personally on Twitter at Adam Koos. So my handle is at Adam Koos, as well as on Instagram at Adam D as in David Koos. Most importantly, if you'd like to schedule an intro call to confidentially discuss your financial situation, your retirement plan in more detail, or if you'd like to get a second opinion on your investment portfolio or retirement plan, please head over to our website at libertaswealth.com. Click on that button in the middle of the homepage that says see if we're a right fit for you, and someone will reach out to get something set up on the calendar at a convenient time that works for you. Last but not least, all links, charts, visuals, they're always on our website. They're always on YouTube. So feel free to, if you're listening on iTunes, Spotify, and you're not watching this time, again, the relative rotation graphs we're going to be showing you today are pretty cool, and you're probably going to come back and look at these after hearing about it and through your headphones. So let's go ahead and jump into it. So we're showing off with relative rotation graphs, one of the easiest ways to visualize relative strength in the markets. The quote of the day is by the guy who invented relative rotation graphs, and somebody that I'm proud to call a friend of mine and a mentor, I suppose, in Julius de Camponer. He's a quantitative and technical strategist, and he is, like I said, the inventor and creator of the relative rotation graph, or RRG for short. And Julius said, before the trends change, the momentum will change. And that's what relative strength, again, is all about momentum. Goes back to Newton's law again. I don't want to repeat it, but Newton's law, I'll screw it. I'm going to read it anyway. I'm repeating it. An object in motion must stay in motion until opposed by an equal or opposing force. So when trends go in motion, they tend to persist for a while until they end. Or as the saying goes, the trend is your friend until the end. And then there can be a downtrend, and that when things turn around, those trends tend to persist. And then, of course, there's the third one, which people tend to forget, which is the trendless environment, or when there is no trend, and there is such a thing as a trendless environment. So before the trends change, the momentum's going to change. And that's what relative rotation graphs are all about. So let's talk about those. First of all, let's get some definitions out. What is a relative rotation graph. How does it work? When you look at the middle of an RRG, and that's what I'm going to call them from now on just to save time here, think of the center point in the middle of the X. It's like, you have these 4 squares, and in the middle, the crosshair, the center point, is the benchmark. So the benchmark is whatever you want it to be. It could be the S&P 500. It could be the Dow. It could be the NASDAQ. You could even get out of the stock market altogether and say, well, I want my benchmark to be the bond market. So let's just say you want it to be the AGG. You could say you want to compare all kinds of different commodities to the overall commodity index, which might be the DBC, for instance. So the center point on the RRG is the benchmark you define. And then there's 4 quadrants. The upper left quadrant, quadrant 1, is if a stock or investment ETF is in that quadrant, that means it's improving versus the benchmark, improving versus the center point. If it's in the upper right quadrant 2, that means it's leading the benchmark or it's beating the market, whatever the market happens to be, according to your benchmark you define. If it's in the lower right quadrant, quadrant 3, that means it's weakening versus the benchmark. That means it's kind of in a weakening state. And then last but not least, quadrant 4, the lower left, is lagging, means it's underperforming versus the market. So when we look at an RRG, this is what one looks like here. And I pulled up the Dow Jones, so there's 30 stocks in the Dow Jones, and the center point, or the benchmark in this case, is the Dow. So what we're doing is we're trying to say, okay, how are all the stocks in the Dow performing on a relative basis, on a momentum basis, versus the Dow Jones Industrial Average? And as you can see here, I'll just pick a couple. Nike is moving northeast from the, not quite the lagging quadrant, but it's in the improving quadrant. Each dot here on the arrow is 1 week, because these are weekly relative rotation graphs. We can also make it 1 day, by the way. If we want to get really long term, we can make it 1 month. I wouldn't do that, but I stick to weekly RRGs. So every dot's a week, and the more space you have between each dot means more velocity, means it's more momentum. Same thing if you see a stock way outside the middle, that means it's got more velocity, it's got more momentum, more opportunity for growth, assuming it's in the right place in the chart, of course. See Verizon, same thing, pointing northeast. Disney, pointing northeast in the improving quadrant. But then we have Amgen. Amgen's kind of pointing southeast in the leading quadrant. So it's beating the market right now. It's outperforming, but it's pointing southeast, which isn't terrible, but it is pointing down. Caterpillar is weakening versus the market. What we'd want to see with Caterpillar is we want to see it jackknife, which means churn back up and head back into the leading quadrant. But as you look at these RRGs, one of the things you're going to find, and I'm going to pull up an animated one here just so you can see how this looks, but you're going to find that generally speaking, and it's not all the time, but about 70% of the time, the investments you put on an RRG move clockwise. So they tend to move clockwise around the benchmark, and whatever that benchmark is you choose, assuming you're building an RRG that makes sense, of course. So for instance, an RRG that would not make sense would be saying, I want to compare the 30 stocks in the Dow to the bond market. I don't know why in the world you would do that. It would make no sense whatsoever. You might want to look at all the different types of corporate bonds versus the bond market, or you might want to look at municipal bonds, corporate bonds, government bonds, treasury bonds, convertible bonds, credit bonds. You might want to look at a bunch of different subsectors in the credit market and compare that to the bond market overall. But you wouldn't compare stocks to bonds, just like you wouldn't want to compare a bunch of different bond ETFs to the commodity index. That would make no sense either. So anyway, you can see that they kind of tend to move counterclockwise, but every once in a while, when strength and momentum persists, you see these jackknife situations, like the communications sector right here. When this resets, we've got communications up here, leading versus the market. Then it starts pointing downward, weakening. Then you're going to see here it starts to jackknife and heads back up into leading. Obviously, a very strong sector in the market, and that strength persists over time. So the upper bar slider that you see up top here is just time. When I animated this GIF, it's just showing you week over week. You can see the date here. If you squint your eyes here, you can see what the date is with each tick. And then we're looking at momentum over time, and on the RRG, in this case, we're looking at the major sectors within the S&P 500, so all the different sectors compared to the S&P. So I know this moves really quickly, but let's see, this is July. We're seeing real estate, energy start to improve, and as we get into September and October, energy's outperforming, but it's starting to point south. So anyway, you can kind of sit on this slide and hit rewind and watch it over and over again to kind of analyze how it works, but it's pretty cool stuff. So let's move on. Like I said, it doesn't have to be stocks, though. We want to make sure that the benchmark we're using makes sense compared to the investments we're comparing it to. So in this case, what I did is I put together an animated GIF of an RRG that compares a bunch of different bond sectors or bond ETFs in the market to the AGG. Now, these things are really tight. It's like spaghetti here in the middle. And what that's basically telling us is there's not really a whole lot of over or underperformance of the individual bonds in the market, or individual sectors of bonds, I should say, compared to the overall market. When we go further outside, you can see here TBF, that's short. TBX is short the bond market. So being short the bond market simply tells us that owning bonds just isn't all that great. And what we can see to confirm that is if we go to the opposite end of the RRG and we look at the lagging quadrant here, we can see 30-year zeros, so 30-year zero coupon bonds, and then 20-year treasuries, the TLT, are both underperforming and lagging the market and just kind of camping out down there. This RRG kind of started in the middle because of the way I animated it, but if we went back in time another year or 2 years even, first of all, it would take a whole lot longer to see the full animation, but you would still tend to see, for the most part, zeros, TLT, and longer dated bonds in the lagging and weakening quadrants, and then you would see short bonds in the leading quadrant, but everything else is pretty much just spaghetti, kind of rotating around haphazardly in the middle here, because as rates have gone up, bonds have gone down. It's not a matter of speculation. That's just how the bond market works. So when rates go up, bonds go down. The shorter the maturity of the bonds, the less it hurts. The longer the maturity, the worse it hurts. If you own 30-year bonds, rates go up, you're gonna feel it. So anybody who's owned bonds in their portfolio this last 2-3 years has known exactly what I'm talking about. So until the Fed starts changing their mind about hiking rates, we're still probably going to see weakness in the bond market. So first thing you want to do when you put together one of these RRGs is select your benchmark. By the way, you can do this for free on stockcharts.com. I use Optima, which is a paid software. It's $2,500 a year, and it's incredible. It's the most powerful analysis tool on the market, without a doubt. But if you just want to do this for free and for fun, head over to stockcharts.com and you can do it there. In fact, Julius de Campaner, the inventor, he, I think, might even answer questions from time to time on their blog. So check that out. But anyway, set your benchmark. In this case, I set the AGG, which is the Barclays Aggregate Bond Index. Then you upload your inventory, or put whatever inventory you want. You can input symbols one by one. You can upload an inventory. But in my case, I put corporate bonds, agency bonds, convertibles, treasuries, and then short bonds, and among others, into this RRG. And then you can kind of play around with it and see how it looks, and you can use it as a tool. So moving on, one of the things to understand about building a strategy or a portfolio management strategy with an RRG is that things aren't always as they seem. Got a little funny GIF here with the not a GIF, but a picture here with an Apache helicopter in the rearview mirror. But first of all, it's easy to assume that what we should be doing is buying leaders. So when you see stocks in the leading quadrant, usually what people see is, I want to buy the leading stocks. And the truth is, when you look at the studies, it's actually a little bit late when you buy the leaders. So building any strategy, it always requires testing. And I think that's really important. You got to test it. You want to not only test it in a good market, because obviously stocks go up in a good market, right? It's like when the tide comes in, stocks come in. When the market goes down, it's like the tide too. When the tide goes out, the stocks go down. But you also want to test over neutral markets. So that would be for instance, the testing period we use all the time is January 1st of 2000 to April 1st of 2013, which is 2 crashes, 2 recoveries, but a neutral market where the market went nowhere for 13 years. And what that tells you is your strategy is going to work in good markets, bad markets, and flat markets. So sometimes what happens, and case in point with an RRG, is these tests produce really, really surprising results. So when we look at results of a very, very popular weekly test, this was one that was produced, I believe, by Julius de Campaner and Matthew Verdau, the owner of and inventor of Optima. When you look at a weekly RRG, the investments that are in the lagging quadrant are the ones we want to buy when the arrow is pointing northeast. So when you look at an RRG and you see a stock or an ETF or whatever's in your inventory in the lagging quadrant and it's pointing northeast, that's typically a good early entry point. Now, is it guaranteed to go up? No, of course not. And that should go without saying. Another bonus here is that the further away you are from center, then the more spread out the dots are. Remember, dots are either each day or each week. Then the higher the momentum and velocity of the investment in question. So one of the things you can do with Optima, which is just, one of the things that makes Optima so amazing, is you can use filters and you can program it. So what I did here was I took the S&P 500 to cut out all the noise, because obviously the S&P 500 has more than 500 stocks in it. You wouldn't want to try and look at an RRG with 500 stocks. It would you talk about spaghetti earlier, be like angel hair, right? So there'd be so much on here, you'll be able to see anything. So what I did was I programmed Optima to give me all of the stocks on the S&P 500 that were pointing northeast on the chart, no matter what quadrant they were in. And then what I did was I put a 2 standard deviation filter in the middle, which now we're getting really nerdy. But what that did is it got rid of all the stocks that really aren't exhibiting high momentum. Where stuff that's really, really close to center is pretty much performing like the market's performing. So whereas what we're looking for stuff that's a little bit further out from center, which is going to give us a little bit more of an edge. So as you can see here, I took all the stocks in the S&P 500. I programmed Optima. This takes about 14 seconds for it to run through all 500 stocks, and it gives me all the stocks here that are pointing northeast. Stocks like AES, Etsy, Dexcom, Dollar Tree. So you can go through here. Some of the ones that are in the improving quadrant, you can go up here and see what those positions are. But once you get up into the leading quadrant, once you're looking at energy, CBOE, United Healthcare, a lot of these companies, I don't want to say it's too late. It's not that you can't buy them. It's just some of the growth has already taken place. Not that you can't buy it next time it comes around the RRG, but you'd be better off looking at the studies and seeing that it's better to catch these investments as they're leaving the lagging quadrant and heading into the improving category pointing northeast, if that makes sense. One more thing I wanted to show you. This is just an individual stock, symbols PDD. And this is, again, just kudos to Optima for their amazing software development. I'm colorblind, which is why this chart might look a little weird to you. But what we were looking at is color-coded candlesticks based on what quadrant the stock is in. So you can see this is PDD. I threw a moving average on here just to trend, to smooth out the candles and the choppiness. But as you can see, whenever we see improvement in the chart, you can see the color change. You can see as things weaken, red is bad. This color right here is weakening. So it goes from here, you can see improving to leading, back to improving, and now it's weakening, and now it's lagging, tries to get an improving, lagging, and it just can't seem to make it. And then as it comes back up again, you can see here, it goes up to leading, weakening, weakening, and so on, back to lagging. But you can see on a chart how this momentum works. In fact, when you're looking at RRGs and you're analyzing them for your portfolio, what you should do is once you find a position that you like in terms of where it's at on the RRG, is you should go to a chart and you should analyze that chart before you should even think about buying it. And speaking of analyzing the chart, buying it, another thing you got to do is you have to have an exit strategy. So we want to tread carefully here. This is a really, really cool software. It's something that you can use in any type of market. You can use it for any type of stock, for any type of ETF. It doesn't really make a difference. But you always want to make sure, again, you set up the RRG correctly. You don't want to have an RRG, again, that compares U.S. stocks to a commodity index. That wouldn't make any sense, and it's not going to help you. It's probably going to hurt you. We discussed entry points today, how buying when a stock or an ETF is pointing northeast out of the lagging quadrant, how that's a potentially good entry point, but we didn't talk about exit. So you always have to have an exit strategy, and more than anything, if you have an exit strategy, you have to follow it, because if you don't follow it, you don't have an exit strategy. And to be a successful investor, you have to have two things. This goes away from RRGs, this goes away from technical analysis, this goes away from relative strength investing. This is just tenets of being a good investor. The first thing is you have to have interest in the subject matter. If you don't like this stuff, then you're probably not going to spend time on it, and that's the second issue, time. So you have to have interest and time. If you don't spend the time on it, you're not going to like the results. If you don't have the interest, you're not going to spend the time on it. And many people, even if they have the interest and they really love it, they don't have time. They're busy being a good dad, a good mom, a good husband, a good wife, a good partner, a good employee at work. They're just too busy. They don't have time to mess with this stuff. There are some that do though, and there are some that can do a really good job on their own. I'm not saying that you can't. For those that don't feel like they have the time and or the interest though, or they just can't seem to figure out how to get it to work for them, that's thankfully, as we joke at our office, why we have a job. So if you ever have any questions about your portfolio and you'd like to confidentially discuss your situation further, what we do is we start with a 30-minute intro call. We can talk about what you've done so far for retirement. We can talk about whether you have a financial plan or not. If you don't, you definitely need one. If you have one, we would give you a second opinion on that, or at least discuss our process for giving a second opinion. But the first thing we start with is always a phone call, 30 minutes long typically. And if it makes sense to move on from there, great. If not, we part as friends and that's it. There's no cost. So if you have any questions, without a doubt, please reach out to us and let us know. But otherwise, that's going to be the end of NERDvember for 2023. So thank you again for all your time. I hope you learned something. If you do have any questions about anything at all, please reach out to us via email. You can head to our website and set up an intro call. And you can just head to our website and send us a message. Don't feel like you can't ask a question. We always say you don't have to be a client to ask a question. So thank you again so much for your time. Hope you have a wonderful holiday season. We'll be back with more podcasts that aren't so nerdy starting in December. But I look forward to talking to you soon.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koos. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.